Now, understanding high yield bonds. Now, high yield bonds is a very important category for investments for banks. Now, many times banks have a separate desk which targets high yield debt. Now, when we say high yield debt, these are bonds on those corporates which may not have a very strong credit standing. So that's why the name high yield bonds. So the way to maybe slice and dice the word high yield bonds is these bonds are going to carry a higher yield because the thing is their credit standing is low, so naturally the spreads for these bonds are going to be higher. So that's why we try and have this connotation of high yield bonds. Generally, the yield on these bonds is higher. Of course, the traders who are transacting on these bonds are taking on additional risk, but those banks who have that kind of a risk appetite and a risk tolerance in order to trade these high yield debt generally set up a separate desk who looks at high yield bonds. Now, looking at a few types of high yield bond issuers to understand them well. So, firstly, original issuers. So, original issuers could be in a few types. So, firstly, we have young or growing companies. So, these are companies who are comparatively new and they do not have a very robust balance sheet or an income statement as compared to a certain well-established company which has a very proven track record. Because these are newbies, right? Now they don't really have a very strong balance sheet at the moment. They're still in the growth phase. Now, the debt for such companies is generally sold based on the promise which their business model gives. So the idea is the business model is projected to be the one which can promise certain good returns in the future, and the idea is to attract more and more investment in such bonds because that is going to guarantee funding for these kind of companies as well. So based on the strength of the business idea, we find these young or growing companies are able to issue bonds. These are also called as venture capital situations or growth companies. The synonymous terms used for these. Now, why the term venture capital? Because we know that venture capital firms are those who are generally early investors whenever we talk of any startups. Now, venture capitals also have that kind of risk appetite in order to take positions in or make investments in young or just startup firms. So that's why the name venture capital situations or growth companies. But in general, these are the companies who have a promising business model, but at the moment, they don't really have a very robust financial situation. But they are growing, so I mean that's how they attract capital. Next is companies who are well established. That is, their operations are going on smoothly. But if we look at their financial situation, then they are falling somewhere midway. So when I say midway, they are neither on the top end of the spectrum. That is, they are neither on the investment grade nor they are on the junk grade. They are somewhere in between. So, but however, they have a very robust operational framework which is currently on. So again, these are also firms who may be classified as original issuers. And third could be subordinated debt, which is issued by investment grade issuers, and that also gets classified under this category. So we know that subordinated debt is, so this is something which we study as a part of the securitization process. So whenever we have securitized assets, something like maybe an ABS, an asset-backed security, we may have a senior and a subordinated debt. That is, we have a senior tranche and a subordinated tranche. So a similar idea we are applying here as well. Whenever we talk of subordinated debt, this is the debt which has a certain level of seniority, but that level of seniority is below your senior most tranche. So that way, that's why we call it as a subordinated one and not exactly the senior debt. However, yeah. Also, next are fallen angels. So fallen angels are those companies who were previously investment grade. So we know investment grade starts right from AAA until triple B. Now, those who were previously investment grade, but now they have fallen to below investment grade or junk grade because of a variety of reasons. So, a few reasons can be maybe a weak balance sheet position, or maybe weakening cash flows, or an income statement which is not very, very robust. So, these could be a few reasons as to why a company who was previously an investment grade firm has dropped to a below investment grade category. Also, these firms can be near default or bankruptcy. So they haven't really filed for bankruptcy yet, but they are very, very close to bankruptcy. Now, the question may be what type of investors would actually want to participate in such opportunities? So, these are specific investors who generally have a higher risk appetite. And the main idea behind making investments in such situations is that they would want to know the value of the debt in case the firm goes in for a reorganization, or finally, even if the firm has to be liquidated, it could either be within or outside bankruptcy courts. But if that is to happen, then what is the value on the debt? So again, this is a slightly risky investment. So those market participants or investors who have a higher risk appetite would pursue such an opportunity. Now, again, as I mentioned, it's a risky bets, and although this may have a potential to generate high returns, it has been observed historically that not every issuer is able to recover from this condition, or rather, I would say majority of the issuers find it difficult to recover from this situation. So, investors who are investing in such opportunities need to have a very high risk appetite in order to take positions in such securities. Then there are deferred interest bonds. So, by the name deferred interest bonds, we can make out that there is a certain lag before which an interest gets paid out. So, that's precisely what we have written here. So, these are bonds which do not pay coupons for initial few years of the bond's life, generally 3 to 7 years. And also at the same time, they also sell at a deep discount from the face value. That's basically uh, compensating the investors for not receiving the coupon for a considerably long period of time. That's why they have to be sold at a discount. Then there are step up bonds. So when we say a step up bond, that implies that the coupon payment on the bond is going to step up over a period of time. So let's say I have a quarterly coupon paying bond. So let's say I start with maybe 0.5% of coupon. Then this could go to 1% in the next period, then maybe 1.5% and 2%. So this is what we call as a step up bond, whereby the coupon payment is going to rise over or during the life of the bond. Next are PIK, or payment in kind bonds. Now, these are the bonds which give the issuer an option to either pay cash or to issue new bonds, and that is with the same coupon and with the same par value as the older bonds. So these two options are available: either pay in cash at coupon dates or issue fresh bonds. And the period during which the issuer can make this decision is 5 to 10 years. Now, a popular example for PIK bonds was, so for those of you who follow football, when the Glazer family had acquired Manchester United Football Club, they had offered the payment in the form of PIK notes to investors. So that was something which had happened a few years back. So those of you who track football news would be familiar with this. So that's exactly the same PIK that we are talking about here. Now coming to restructuring and LBO. So LBO stands for leverage buyouts. Now, these include firms that have significantly increased their debt levels. So, when I say debt levels, we can imagine this is nothing but financial leverage, because we know from the definition of financial leverage that this is like a fixed interest cost for any company. So, as the company issues more and more amount of debt, they have to service that debt with a certain coupon payment as well. So, that is going to put an interest pressure on their cash flows, and again called as financial leverage. But uh, we know that financial leverage has a potential to improve or enhance stakeholder value. So those firms who increase their debt levels with the view of enhancing stakeholder value. Now, existing stakeholders could be a group to whom the company pays out extraordinary dividends, and maybe the funds for these can come from the sale of certain assets of the company. Now, as a result of these actions, what happens is the credit ratings for these issuers drop. So, as the ratings drop, naturally we know that the riskiness of this debt is going to increase. Due to this reason, any kind of new debt which is issued, it will have to be issued at a lower or a junk rate rating. Now, in an LBO transaction or a leverage buyout transaction, a new private stakeholder group is going to own and run the company. So the idea is they come over and they take over the company and they start running the show as well. Now, the debt's issue purpose, or whatever debt has been issued, the purpose will be to retire the debt from any kind of commercial or investment banks, that is the bank borrowings which were incurred in order to finance the LBO. Also, the debt to be retired is known as bridge financing. So again, a technical term. So why we call it as a bridge? Because Uh, it's called as a bridge because we are trying to move from the initial LBO transaction into something which is more concrete, or what we call as a permanent financing at a later point in time. That's why the word is called as bridge financing.